Welcome back, friends. So, as I had pointed out in the early part of the week on Monday itself, you may see a rather difficult week, negative week for stocks. Wednesday turned out to be some respite for the US stock markets, but they have again turned downward once again. In my video, which I had published a little while back, I have explained how the yen carry trade is expected to play out. Whenever you have the unwinding of the yen carry trade, that does have an impact on stocks. How long that can last is a question mark that I will address separately. Recent economic data from the United States shows that a job growth in the US has slowed much more than expected during the month of July, and the unemployment rate has ticked higher, according to the US Labor Department. Non-farm payrolls have grown by just 114,000 for the month, down from the downwardly revised 179,000 in June and below the Dow Jones estimate for 185,000. The unemployment rate has edged higher to 4.3%, its highest since October of 2021. Average hourly earnings, a closely watched inflation barometer, has increased 0.2% for the month and 3.6% from a year ago. Both the figures were below respective forecasts of 0.3% and 3.7% respectively. Stock market futures have added to the losses following the jobs report, while the treasury yields have plummeted. The report adds to the mixed signals recently about the economy and with financial markets on edge about how the Federal Reserve will respond. The labor market had been a pillar of economic strength along with the consumer spending, but the labor market has recently shown some signs of trouble, and the July payrolls increase was well below the average of 215,000 over the past 12 months. From a sector standpoint, the healthcare again led in job creation, adding 55,000 to the payrolls. Other notable gainers included construction 25,000, government 17,000, and transportation and warehousing 14,000. We had leisure and hospitality, another leading gainer over the past few years, adding 23,000. The information services sector posted a loss of 20,000. That's not very good. Look at the Intel forecast of cutting 15% of its workforce, which means that further the August jobs report will also not be very good when it gets released in September. While the survey of establishments used for the headline payroll number was discouraging, the household survey was even more so, with the growth of just 67,000, while the ranks of the unemployed swelled by 352,000. The labor force also contracted by 214,000, though the participation rate as a share of the working up age population actually edged higher to 62.7%. All does not augur well. It shows that a Federal Reserve may have to hasten an interest rate cut, which may actually be positive for the markets. However, the concern of the market today is that is the US Federal Reserve running behind the curve? And that's what is adding to the negativity in the futures. We had forecasted this far ahead of anybody else on Monday itself, and I mentioned this will be a negative and a sharply negative week for stocks. In between the session today, you may see some little recovery around noonish, but once we cross 130 mark, again you may see a fresh wave of selling come again. Be cautious in trading today. There is not only the question of the job growth slowing down, but also the unwinding of the yen carry trade. How this both will play out, along with the uncertainty surrounding the US presidential elections, is something that you need to take care of. It makes for an unholy cocktail. We will tell you where we are headed from here. Do join our Prime or Prime Plus Telegram groups, which are addressed specifically for forecasting the US stock markets, the Dow Jones, S&P, and NASDAQ as they open for trading today. And our forecasts cover the next few days, new weeks, and months ahead. Do WhatsApp us on 982-086-1044. Alternatively, you may also email us at globalmoneyinvestor@gmail.com. It is globalmoneyinvestor@gmail.com. Have a great investing day ahead. Take care. Bye-bye.